Good evening, everybody. I was a little worried that with Phillips Hagen North going first, I might lose half of you, but well, we'll talk about the Global Equities Fund. Try not to be too verbose about it, but just to kind of remind you what we do in the Global Equity Fund. It's very much a value-oriented strategy in that we try to find securities and markets around the globe that are trading at attractive valuations. It is, we do use closed-end funds in this strategy, which are a very highly diversified vehicle. And while City of London itself is a relatively small company with limited resources, by using closed-end funds, we access global managers around the world who do have very deep resources. So in this fund, you are getting a very diversified exposure to global equity securities. We invest in closed-end funds because closed-end funds have unique advantages where they trade at discounts to net asset value or their underlying worth, and those discounts move around over time, and what we do is try to take advantage of the valuation discrepancies, and there's some examples of that. And really, reversion to the mean is a key part of our strategy. So what we look for is funds which are particularly out of favour and selling at wide discounts, and our experience is that over time, those wide discounts don't last. And so what you have is reversion to the mean, and as you capture that discount narrowing, if the underlying manager, even if they just track the index that they're trying to invest in, and many of them actually outperform those indices, but we're correct on the discount decision, you're going to outperform by around 300 to 500 basis points in each position. So that's really what we're trying to do within this portfolio on an ongoing basis and to capture that. So it's very much a different type of strategy to your traditional stock picking type strategy that Phillips Hagen North run, because we are much more diversified. Our key source of our performance is capturing these discount inefficiencies. And we've been doing this for a long time, so that doesn't really mean anything, but we've seen a lot of these closed-end fund movements. Why does it exist? Very briefly, the main reason is because generally investors in closed-end funds are not valuation sensitive. They tend to be wealth managers and individual investors who will invest in these funds and it's more of a flow based. So, for example, as a wealth manager has clients that invest funds with them, they will have an approved list of securities and they will invest based on that approved list of securities. So they're not really looking at valuations. And those investors are around 95% of investors in closed-end funds, so they really are the ones driving the pricing of these securities. And so what we do as valuation-sensitive investors is take advantage of those valuation anomalies that get thrown up, and a lot of that can be due to sentiment, it can be due to the fact that a particular market's out of favour or a particular manager has gone through a short-term period of underperformance, and that can lead to discounts widening, and that's kind of what we look for within our universe of securities. So just to kind of put that in some context, there's a couple of examples. Alliance Trust, which was a 5% position in the Tradex Global Equity Fund. This fund is a global equity fund. It's diversified. We've got about 100 holdings globally. It's a very large closed-end fund listed in the London market. And this is a fund who has had an activist investor pressing for the board to narrow its discount. And as you can see on the second chart, this used to trade at an 18% discount. It now trades at around about 5% discount. And so we have sold your position in this fund, capturing that discount movement. Fidelity European Values is another large position within the Tradex Global Equity Fund. It's a diversified European regional closed-end fund. It is pretty steady in terms of incrementally outperforming the index over time, but it has very much a volatile discount. And that bottom chart just shows the level of discount and how it changes over time. And the black dots there are where we bought shares in this fund, and the red dots are where we sold shares. So as you can see, we effectively buy when this fund is cheap, and when it gets to an expensive level, meaning the discount's narrow, that's when we're going to sell. So we've had a lot of talk about market performance. Obviously, last year was a very good year. I was thinking on my way here what an interesting year this has been. When we was here last year, obviously it was before the Brexit vote in the UK and before the US election, so it's been quite an interesting year. But you know, overall markets returned around 20%, and a lot of the markets which outperformed last year were some of these emerging markets. Now, that's great, but it was very much a rebound from a low level. So if you invested for the last 5 years, you've been quite disappointed in your returns. But this is kind of the cyclicality of markets, in that nothing goes down forever and nothing goes up forever. But you know, the gain in Brazil, it's 50%, but if you were down, you know, 50%, you actually haven't recovered that with that gain. But emerging markets did do reasonably well last year. The US and Canada was pretty much in line with the global benchmark, and European markets were a little bit weaker. Canadian dollar, kind of similar story, very much, as you're well aware, slightly weaker against the US dollar, and then stronger against some of the European currencies. In terms of performance of the fund, over the last year, a pretty good year, both in absolute terms and also relative to the MSCI World benchmark that we use as the tracking for the performance. The bottom section of this page just shows where that performance has come from, and it's primarily due to it was 351 basis points overall. All of that performance came from taking advantage of discount opportunities. There was a little bit added through NAVs, and that number's a little bit reduced because that's the element of our attribution where the expenses of the fund goes. And in terms of currency allocation, country allocation, we're a little positive on country allocation and a little negative on currencies. And that was mainly because after the Brexit vote, we did increase our exposure to the UK, and that currency continued to weaken. And we'll go through some of the opportunities there from that situation. This chart just shows the size-weighted average discount of the fund. We're constantly trying to invest in the cheapest securities. So what you can see is over the course of the year, discounts have narrowed, but this last down leg is really instructive in that what that means is things like Alliance Trust, also Monk's Investment Trust, which was another large holding, they all got to below 5% discounts, and that's obviously dragging the size-weighted average discount narrower. So we're selling those securities and investing in other securities which we're trading at wider discounts. Performance drivers for last year. Well, the first one should be on there every year, which is opportunistic discount trading. This is what we do. We look at all of the funds in our universe and look at where the best opportunities are at any given point in time. So we're always looking to maintain a broad market exposure, but we're looking to provide that by investing in funds which offer the best values. In terms of allocations which were helpful, we did have a position in a MLP, Master Limited Partnership closed-end fund. This invests in a lot of the pipelines within the US. They had been very heavily sold during 2015, and they rebounded very sharply, both in terms of the underlying companies, as well as the oil price rebounded, but also through the discounts at which they traded during that sell-off. That's when you see these discounts really appearing. It's a unloved asset class and wider discounts. Technology sector exposure, we have some dedicated technology funds. I'll go on later that we are underweight to the US market, and the vast majority of technology companies are in the US market. So what that means is that if we're underweight to the US, we're probably going to be underweight to technology. But we do like the technology sector, and we have a closed-end fund, a number of funds which are trading at wide discounts. For example, talk about the Brexit situation. There is a technology fund listed in the London market that traded out to a 12% discount after the vote. Now, global technology companies, as far as I'm aware, not going to be really affected that much by Britain leaving the European Union. And so that's a situation where it's just market panic driving discounts wider. And so we invested in a 12% discount. It narrowed right in, technology outperformed, and we sold it around a 2% discount. So that's 1,000 basis points of outperformance on that position. Equally, financial sector, again, since the financial crisis, the financial sector has been very much unloved. Discounts trading at very wide levels, and as we've gone through the course of the year with the prospect of a little bit higher inflation, some interest rate rises, which improves the margin spread for the banks, we've seen financials start to outperform. So again, we've seen a situation where you have an unloved sector, wide discounts, that starts turning around. You get outperformance from the sector and outperformance from that discount narrowing. I mentioned a couple of times the Brexit vote. This created a lot of dislocation within the UK market. There was a lot of panic selling in the days after that market, that vote. And so we added to positions aggressively after that vote, and they narrowed subsequently. And then finally, in terms of contributors, we have some exposure to small and mid-cap securities, which again have done very well versus large caps. What hurt us, being underweight the US slightly outperformed the global benchmark, so that was a slight negative. It's around 60% of the benchmark, so it has an impact. Having the UK overweight, while it helped in discounts, that currency move did hurt us. That has started to come back. We've had obviously the announcement of the election in the UK, and so that is the sterling has appreciated a little bit. Being underweight to Canada and Australia, that was kind of a move gradually throughout the year, kind of after a substantial portion of the commodity rebound, but those markets continue to do relatively well after that as well, so that hurt. We have had some exposure to healthcare and biotech, which has been very volatile, particularly around the election, and that at the margin has hurt performance as well. A couple of Japanese closed-end funds also underperformed on an NAV basis, and a UK small company trust, Artemis Alpha, also did poorly. Next few charts, I've got just some charts of the average discount. And what really is important to know is that the universe of closed-end funds is very diverse, both in terms of the underlying exposures that you can access, but also the discounts at which they trade. So you can look at this chart and you can say, well, discounts move around. I think I've gone to the wrong page. There you go. Discounts move around a little bit, but actually what you need to know is that there's a 10% channel around this average of the middle 50% of discounts. So there's a lot of volatility within the average that is really where we're looking for opportunities. This chart just shows what's happened in the UK market, and you can see really the large drawdown in 2016 associated with the Brexit vote. And discounts had started widening ahead of that vote, but really subsequently to the vote, it really exacerbated. That is a situation that, you know, we've seen time and time again in markets where a particular event causes a large sell-off, causes wider discounts, but that's the time you want to be aggressive in buying those discounts. Because what happens is what's happened subsequently is those discounts mean revert. And so that's a lot of the discount outperformance that's been captured. And it's been driven to some degree by a lot of the global equity funds. That's some of the Alliance Trust and Monk's Investment Trust that I mentioned. And where it hasn't really changed and where we're continuing to be exposed is some of the UK funds, still the large cap funds, which had traded at quite narrow discounts, have widened out. That is anomalous. We expect that to mean revert. Equally, there's a lot of value in UK small cap funds. They've done very well from an NAV basis, meaning the underlying companies have done very well in the last kind of 6 months. So that's paid off, but there are still wide discounts there. Equally, in European equity closed-end funds, there's also a lot of value, and so we have positions there. And then in the US, you know, pretty much still trending wider. We did see a bit of a blip with the election of President Trump, but that has been reverted as well. As we kind of go on to the global environment, obviously the main unknown is, and the X factor is Donald Trump. I think that there's a lot of unpredictability in terms of what he may do. There's also a lot of unpredictability on you know, what the range of possibilities are. And I think, you know, a lot of people will say, well, you know, what is he going to be able to achieve in this presidency in terms of his agenda? And I think the fact that Donald Trump, to my mind, doesn't really have a specific ideology. And so people who say, well, he's going to be a terrible president, I don't think you know that. I don't think we know whether he's going to be good or bad. Because there is so much unpredictability and lack of ideology. The fact that it seems that there's the populist streak, I think means that what we could see is a lot of market positive measures, which will be great now, but we're probably going to pay for later on. In terms of other things going on, obviously employment in the US is very strong. We haven't really seen that come through in wage gains. There has been a little bit more inflation, and obviously we've got the Fed starting to raise interest rates, and that's supported the dollar. You know, I think with the rally that we've had, a lot of good news has been priced in, and I think that it's probably going to take a while for some of that to play out. So, you know, US markets, certainly we would agree that there's probably some potential for that to underperform in the near term. Obviously, the UK have got a general election coming up. That should improve the negotiating position for the government. So we are optimistic that that may be less bad than what has been muted in terms of a trade deal. Certainly what we hear from managers of UK closed-end funds is that the environment is still pretty good for UK companies. And a lot of them are very much, as we've said before, internationally exposed companies. European elections very much in focus. We've had the first round of the French elections. I think this will be kind of the key event. If Macron wins the election, then I think European equities have good potential for this year, particularly as some of the earnings growth which is coming through. They are, we think, attractively priced relative to the global opportunity set. So we're very much optimistic that will come through. I think the big X factor is geopolitical events, particularly with Trump in the White House. We just don't know what he might do, for example, in North Korea. So that is going to be something which could absolutely throw off markets. And if you look at markets right now, I think Phillips Hagenorth had the confidence index. When everybody's confident, that isn't always a great time. Right? That when everybody thinks everything's great, a lot of that is priced into the market, and it often doesn't turn out to be as great as what's priced in. Things don't go up in a straight line, and particularly with the returns we've had in the first quarter already. I think it makes sense to be a little cautious. Emerging markets have revived, as we've said. We do think that from a value perspective, they are cheap relative to other markets. We're just not sure about the fundamental dynamics, particularly with China and what may happen with the growth there. So they're cheap, they have done very well. So we have a limited amount of exposure within the fund. In terms of the positioning right now, just to emphasize, we do have a large underweight to the US market, which has done very well, and where we're overweight relative to the benchmark is in the Eurozone, UK, Japan, and we have a small exposure to emerging markets. As I said, we're also underweight to Canada and Australia. In terms of sectors, we're not big proponents of taking sector bets, and as you look at that chart, you will see that there aren't too many large sector bets. What we do though is look at sector closed-end funds. We're very cognizant of what our exposure is, and if there are opportunities in sector funds, particularly when, on a look-through basis, we don't have as much exposure in a particular area, and healthcare will be a good example of that. We will access these specialized sector funds. And technology, again, if we would just had our US weight, we didn't have a technology sector fund, we'd be significantly underweight to that sector. So that's pretty much all my comments. We continue to be focused on the closed-end fund discount volatility, and in terms of those allocation decisions, very much outside the US and focused on Europe and Japan as to where the value is within our universe. So with that, happy to take any questions.